Hello everyone, we are from Group 32 and we are going to present the financial analysis of Famanaga Berhad and Hatalega Holdings Berhad from 2019 to 2023. My name is Yap Jongming. I will present the trend analysis based on the financial ratios. First, let's look at the results of trend analysis for Famanaga Berhad. On the liquidity ratio side, the current ratio fluctuates over the last 5 years, and the acid test remains low and stable between 0.2 to 0.3. It indicates that Famaniaga may face liquidity challenges in meeting its short-term obligation. Moving on, the solvency ratio, debt to assets ratio increased slightly each year, shows Famanaga relying more on debt to finance its assets and increase the leverage. Both debt to equity ratio and times interest earned dropped significantly to negative in 2022. The solvency ratios indicates Famanaga may facing potential financial difficulties. The next, market preference. The return on equity fluctuates over the years, indicating poor returns on shareholders' equity and the market is unprofitability. For the price earnings ratio, it shows a negative trend after 2020. It shows that Famaniaga Berhad is not in favor of investor over the last 5 years. On the profitability ratio, all net profit margin, return on assets, and earnings per share fluctuates over last 5 years. Famaniaga struggles with consistent profitability, causing it hard to gain trust from potential investors. Next, let's look at the trend analysis for Hatalaga. First, the liquidity ratio, both current ratio and acid test ratio, increased over the last 5 years. Particularly, it increased significantly after 2022. Hatalega Holdings Berhad has robust liquidity management and very excellent short-term financial health. Moving on to solvency ratio, debt to assets ratio and debt to equity ratio decreased over the last 5 years. It indicates that Hatalega's strong solvency position and reduced financial leverage of Hatalega Holdings Berhad. For the market preference, price earnings ratio is high in earlier year but shows decreasing trends after 2020. The investor shows negative attitude about Hatalega although the company possesses strong performance. For the profitability side, all profitability ratio fluctuates over the last 5 years. It reached the peak at 2021 and 2022 and starts to decline in 2023. Despite strong historical performance throughout the years, maybe due to market adaptability and dynamically changing preference, investors shows their worries about Hatalega potential development and profitability. That's all for the trend analysis. Thank you.
Hi, my name is Chu Wit Shen and I'll be presenting the second question. Which company appears to be a stronger candidate financially? Let's jump to the conclusion. Hatalega Holdings Berhad is a better company in finance. Let me break it down for you. Firstly, considering return on equity, ROE. Hatalega consistently demonstrates efficient utilization of shareholder equity, resulting in positive and relatively high ROE values. Conversely, Famaniaga's ROE varies significantly, indicating potential inefficiency in capital allocation and operational management. Moving on to net profit margin, Hatalega maintains consistently higher margins, reflecting better cost management and operational efficiency. Famaniaga, however, struggles with both negative and low positive net profit margins, suggesting challenges in controlling costs and generating sufficient revenue. Analyzing the current ratio and acid test ratio, Hatalega's significantly higher ratios indicate a strong ability to meet short-term obligations with liquid assets. Famaniaga's lower ratios signal potential difficulties in fulfilling immediate financial commitments, raising concerns about liquidity management. Furthermore, Hartalega lower and more stable debt to equity ratio reflects a conservative approach to financial debt, whereas Pharmaniaga's high and increasing ratios signify significant reliance on debt financing, potentially increasing financial risk. Finally, examining earnings per share (EPS) and price earnings P/E ratio. Hartalega consistently reports positive EPS and higher PE ratios, reflecting positive growth prospects and investor confidence. Pharmaniaga's EPS shows inconsistency and keep going up and down, and its PE ratios are lower or negative, which could mean investors aren't expecting much growth and might be concerned. In conclusion, Hartalega Holdings Berhad emerged as the stronger financial candidate due to its superior profitability, stability, liquidity, and prudent financial management practices compared to Pharmaniaga Berhad. Thank you.
When it comes to making investment decisions, our group takes a comprehensive approach that goes beyond just analyzing financial metrics. We consider a range of factors to ensure our investment align with our values and objectives while also mitigating risk and capitalizing on emerging opportunities, which include risk assessment, economic environment and market condition, sustainability and ethical considerations, technology and innovation trend. One of the key factors is analyzing the broader economic environments and market conditions that could affect the performance of our investments. This includes monitoring interest rates, inflation rates, economic growth rates, and market sentiment. By staying informed about macroeconomic trends, we can identify potential risks and opportunities and adjust our investment strategies accordingly. Another crucial factor that we evaluate is risk assessment. We thoroughly understand the various risks associated with an investment, including market risk, credit risk, liquidity risk, and sector-specific risk. This involves evaluating the volatility of the investment and the potential for financial loss. By conducting a thorough risk assessment, we can make more informed decisions and implement strategies to manage and mitigate potential risks. In addition, investors are considering the social and environmental impact of their investment, known as ESG, environmental, social, and governance factors. We prioritize investment that align with our personal or corporate values related to sustainability and ethical practice. This includes supporting companies and initiatives that promote environmental stewardship, social responsibility, and good governance practice. By incorporating these considerations, we can contribute to a more sustainable future while also potentially enhancing long-term value for our investments. For investment in technology or rapidly evolving sectors, understanding current and emerging trends is crucial. We closely monitor technological advancement, disruptive innovations, and shifting consumer behaviors. These insights allow us to identify promising opportunities and potential growth areas, influencing the longevity and potential success of our investment. By staying ahead of the curve and embracing innovations, we can position ourselves for long-term success in a rapidly changing landscape.
To the part of recommended company, we will recommend Hartalega Holdings Berhad based on a comparison of the aspect below. First of all, Hartalega Holdings Berhad has higher asset test ratio. Asset test ratio indicates whether the company has the means to cover its short-term liabilities. Hartalega Holdings Berhad has ratio of 1.0 or more, indicating it can pay its short-term obligations, while Pharmaniaga Berhad has ratio of less than 1, indicates it might struggle to pay for the liabilities. The second part is Hartalega Holdings Berhad has higher inventory turnover ratio. It exhibits a consistently higher inventory turnover ratio compared to Pharmaniaga Berhad over the observed period. It implies that Hartalega Holdings Berhad can more efficiently sell the inventory it buys and manage its inventory wisely. Lower turnover may imply that Pharmaniaga Berhad is carrying too much inventory or experiencing poor inventory management. These unsold inventories can lead to significant risks from fluctuating market prices. Furthermore, based on the debt to asset ratio, Harta Lega Holdings Berhad has a lower debt to asset ratio, which implies lower leverage and possibly better financial health, suggesting a stronger ability to cover liabilities with assets. Moreover, for the times interest earn ratio, Harta Lega Holdings Berhad exhibit a significantly higher times interest earn ratio compared to Pharma Niaga Berhad. This means it can efficiently cover its interest charges with its pre-tax earnings. A better times interest earn ratio also means a company has enough cash after paying its debts to continue to invest in the business. Lastly, for the net profit margin, Harta Lega Holdings Berhad shows positive and higher net profit margins, while Pharma Niaga Berhad shows negative or very low net profit margins. Higher net profit margins indicate that the company is generating more profit from its sales and operating costs are under control. It also shows that it is better managed and more financially stable. Hence, it is a more attractive option for investment or business dealings. For the future outlook of the company, Harta Lega Holdings Berhad has demonstrated strong financial health as evidenced by its impressive ratios. It also has good debt management as its debt to asset ratio is low, which also decreased over the years. This trend also indicates that the company is reducing its reliance on debt, which enhances financial stability and reduces risk. In conclusion, Harta Lega Holdings Berhad has a positive future outlook as it can maintain high profitability and manage the debt effectively.